Hello, everyone. Welcome to the May 1st video cast of the Middle Market Weekly. My name is David Puchowsk, Director of Analysis with Refinitiv LPC. Today, I'm joined by my colleague, Diquez, who helps lead up our middle market content. Hi, Deanna.
Hi, Dave. Hi, everyone.
Thanks for joining the show today. And again, for our audience, we've recently shifted gears a little bit with our Middle Market Weekly analysis. We're trying to focus it harder on the current market while also bringing you these short videos to fill in the cracks with some thoughts coming straight from the Middle Market Weekly team here at LPC. This week, I've put some industry slides together that I think are pretty relevant, so let's get started. And I wanted to highlight manufacturing during this call. Obviously, a lot of sectors are feeling pain right now, but here's a sector that had felt some pain over the past 2 years because of the trade wars. On the left, you see the Purchasing Managers Index, which after a few months of contracting at the end of last year, actually saw expansion months in January and February, and that April number is expected to be very low. Reuters Economist poll has it under 40. On the right is the middle market volumes to the manufacturing sector, which were lower last year. You can see there electronics manufacturers held up a little bit better compared to others. But overall, here's an industry that was just finding its footing when the carpet was pulled out from underneath it in March. Looking at the number of downgrades by sector since mid-February, you see manufacturers have seen the most, at least through last week. 38 of them in the overall market that had their bank loans downgraded. So rating agencies aren't extremely optimistic toward the sector, at least in the early parts of the downturn. These are the middle market bids by sector. You can see healthcare and manufacturing are the lowest for some of these more popular sectors for middle market lending. Even everyone's favorite company name, their Big Ass Solutions. They produce industrial-sized fans. I highlighted them last year as a success story during the trade war because they sourced from Australia and their business was holding up quite well. Their term loan B was bid over par in February, and now it's as low as 73. Which is kind of unbelievable, but considering business investment is expected to be well lower this year, it makes some sense. Here we have overall manufacturing loan bids split up by SIC code category, where we can see which are performing better than others. You see construction materials on the far right there. Those loans are bid lower, as are furniture and fixtures. Of course, many construction projects have been put on hold, and furniture is harder to buy online. The showrooms are closed. But overall, for manufacturers, a lot of it comes down to, can they do just enough? Whether it's get some financing through the government programs and do some outside the box sort of things to get them through this difficult time. I listened in on a call with a few middle market CEOs the other day where they were discussing how each one had been operating through the pandemic. One was a manufacturer who did injection molding and had pivoted to making some of the PPE equipment for healthcare. They were doing okay on cash considering the circumstances. They were managing costs, had gotten paycheck protection financing, and were kicking the tires on the Main Street lending program. Of course, it helped that they were deemed essential and allowed to stay open where others have not been allowed to. But overall, I was struck by the optimism from these company leaders who were pulling the levers they needed to and seemed like, at least for now, things were going to be okay. So maybe if the trough isn't so long or deep as we think, the pain might not be so bad for the sector. Now, Deanna, you cover the oil and gas space for LPC. I'm guessing the road to improvements there is a tougher one. Do you want to walk us through what you're seeing there?
Sure, Dave, and thank you. Well, we've seen that oil prices have been hit very, very hard. We saw the effects that the Russia-Saudi Arabia price war had on prices. And of course, the dramatic drop in demand as the world came to a lockdown due to COVID-19. And we actually saw US prices drop into negative territory last week. Now they're back to positive. However, they're still at a very low level of around $17 this morning. That's earlier today, I saw that they were at $17. And there's been some good news this week. Economies are starting to open up. Some of them are making plans to open up. And this could result in an increase in demand. And some suggest that the worst could be over for this industry. However, $17 is far below the $60 level that we had at the end of 2019. So when do we go back to these levels? Do we even go back to these levels? I was reading Moody's report earlier this week, and they said that they expect the WTI spot price to be at an average of $30 this year. So it seems it's going to take a while. Here we also see the effects that this has had on loans in the secondary market. We see that oil and gas bids fell to as low as 71 on March 24. And since then, they've recovered, as has been the case of the overall loan market. But you can see that the rebound on oil and gas has been a lot less pronounced than the LPC 100. The problem is that at the current level of oil prices, many companies are feeling or will start to feel the pressure soon. In the next slide, we show you some Fitch data. Fitch is forecasting that the US high yield energy default rate will hit 17% this year. That's well above the overall default rate, which they expect to be between 5 and 6%. Now, what's happening in the primary market? In the next slide, we'll focus on the middle market. Here you can see how lending dropped in 2019 and how this decline has continued into this year. Look at the chart in the right. The first quarter volume numbers were even lower than first quarter 19, and they were at their lowest level since first quarter 2016. In this chart, you can also see that a large share of the middle market lending for oil and gas comes from the upstream sector. The upstream sector is exploration and production companies, and the majority of lending to this sector is done in the form of reserve-based lending revolvers, and they're tied to a borrowing base. Now, this borrowing base is typically redetermined twice a year, and we're currently in the process of the spring redeterminations. And what's happening is that, we expect, the market expects that there's going to be a lot of borrowing-based reductions. We have lower prices. Companies are reducing their capital expenditures. They're reducing their production. So it seems like many could get a reduced borrowing base. And in some cases, this could result in borrowing-based deficiencies because the amount drawn is higher than the new borrowing base. So liquidity becomes a big concern right there. So we can see that, we're certainly in the middle of a very critical time for oil and gas companies. We don't know when prices are going to recover, and we don't know if they're even going to recover. At what point? What are companies going to do? What are the liquidity positions? Are they prepared for this? And for now, we'll continue to monitor the sector to see what happens. And of course, we'll keep you posted. Thanks, everyone. And now back to you, Dave.
Thanks, Deanna. For more sector-focused analysis, check out the May 1st copy of the Middle Market Weekly on Loan Connector. For Deanna Diquez, I'm Dave Puchowsk. Thanks for watching. We'll see you next week.